Current market action for TMC, the metals company Inc. on the NASDAQ, shows the stock trading at 5.41 USD, exhibiting a slight intraday decline of approximately 0.18% as we move through the midday session on this Wednesday, November 19, 2025. The stock opened near 5.76 USD and has faced selling pressure, pushing it down from those morning highs, yet it remains resiliently above the 5.40 USD support level. This is not just a ticker blinking on a screen, it is the pulse of a geopolitical chess match taking place 3 miles beneath the surface of the Pacific Ocean. When most retail investors look at TMC, they expect to see a speculative mining play, a penny stock gamble that lives or dies on the whims of commodities futures. That is the expectation. The reality, however, is far more complex and consequential. What we are witnessing right now is not merely a mining company trying to extract rocks. It is a test case for whether the United States can successfully pivot its critical mineral supply chain away from foreign dominance under the new legislative frameworks established earlier this year. The gap between the expectation of a risky penny stock and the reality of a strategic national asset is where the opportunity and the danger lies for your portfolio. While the general consensus on forums discussing Robinhood stock trading often dismisses TMC as a volatile meme stock, the institutional flow tells a different story of accumulation, betting on a regulatory breakthrough that could reshape the global battery metals market. To understand why this stock is trading at $5.41 today, up nearly 500% from its lows just a year ago, you have to look at the catalyst that caught almost everyone off guard. The narrative for years was that the International Seabed Authority, or ISA, was the gatekeeper. Investors believed that without a finalized mining code from the UN-affiliated body in Jamaica, TMC was dead in the water. The reality that shattered this assumption was the aggressive shift toward United States jurisdiction. Following the executive order signed in April 2025 authorizing deep-sea mining and the subsequent application to NOAA, TMC effectively bypassed the bureaucratic gridlock that had strangled its share price for so long. This is a classic example of the market mispricing a regulatory arbitrage. While many were waiting for a stamp of approval from Kingston, Jamaica, the company was pivoting to Washington, D.C. This move forced the market to reevaluate the company not as a helpless applicant waiting for permission, but as a domestic resource provider for the American electric vehicle supply chain. Let's look at the intraday mechanics we are seeing right now. The volume today is approaching 9 million shares, heavily weighted toward the sell side in the opening hours, likely due to profit-taking after the massive run-up we saw earlier in the month. You have day traders using interactive brokers' trading platforms scalping the volatility, while longer-term holders are sitting on their hands, waiting for the next regulatory nod from NOAA. This creates a friction point. The price is consolidating. If you track Tesla stock or Nvidia stock and their historical volatility profiles during their early growth phases, you'll recognize this pattern. Massive news-driven spikes followed by periods of skeptical consolidation. TMC is currently in that consolidation phase. The smart money knows that the Q3 2025 earnings report, which we will analyze shortly, was messy on the surface but structurally sound underneath. The common ground most investors share is the belief that deep-sea mining is environmentally hazardous and financially unproven. This is the safe opinion to hold. It aligns with the headlines. But let's challenge that with a contrarian take that is driving the current valuation. The data released from TMC's environmental impact studies suggests that the abyssal plain where these polymetallic nodules sit is one of the least populated biomass zones on the planet. The counterargument gaining traction in Washington is that terrestrial mining, stripping rainforests in Indonesia for nickel, or relying on child labor in the Congo for cobalt, is infinitely worse for the biosphere than vacuuming potato-sized rocks from the barren deep ocean floor. If this narrative continues to win over policymakers, as it seems to be doing under the current administration, the environmental risk discount currently suppressing the stock price will evaporate. potentially triggering a repricing event that Schwab Intelligent Portfolios or standard SoFi investing algorithms might miss until it's too late. We need to talk about the specific asset class here. We are discussing polymetallic nodules. These are not veins of ore that need to be blasted. They are sitting loosely on the sediment. The hidden gem, the production vessel operated by TMC's partner Allseas, does not dig, it collects. This distinction is critical because it lowers the capex intensity compared to building a land-based mine. When you look at investment help guides or read through Fidelity Wealth Management brochures, they often warn against the capital intensity of mining stocks. TMC defies this model partially because the capital equipment, the ship, is already built and operational. The risk here is not, can they build the mine? The risk is, will they be allowed to turn the vacuum on? Let's analyze the recent financials because the Q3 2025 report was a bloodbath if you only read the headline numbers, but a gold mine if you read the footnotes. The company reported a net loss of roughly $184.5 million for the quarter. On the surface, that looks disastrous for a company with no revenue. However, a massive portion of that loss was non-cash, driven by the fair value adjustment of warrant liabilities. Because the stock price skyrocketed, the accounting value of the warrants they issued went up, which shows up as a loss on the income statement. This is a paper loss, not a cash burn. In terms of actual liquidity, TMC closed the quarter with about $115.6 million in cash and total liquidity of roughly $165 million. This is the vital statistic. They have the runway to survive through 2026 without a need an immediate dilutive capital raise. For individual brokerage accounts holding this stock, that cash position is the safety net. It means they are not desperate. They can wait for the NOAA permit process to play out. The relationship between TMC and the broader EV sector is the glue holding the valuation together. Think about Tesla stock again. The limiting factor for the mass adoption of EVs is no longer demand, it is the supply of battery-grade metals. TMC controls a resource in the Clarion-Clipperton zone estimated to contain enough nickel, manganese, cobalt, and copper to electrify the entire U.S. passenger fleet. Currently, China dominates the processing of these metals. The geopolitical premium baked into TMC's share price reflects the Pentagon's interest in securing a non-Chinese source of these materials. If you are using SoFi Invest or looking for investing sites to allocate capital toward national security plays, TMC has inadvertently become one. It's no longer just a materials play, it's a defense play. However, we must address the elephant in the room, the opposition. Greenpeace and other NGOs are not backing down. They have successfully lobbied sovereign nations to call for moratoriums. The tension between the green transition, needing metals, and ocean conservation, protecting the seabed, is the central conflict. This creates volatility. Every time a celebrity tweets about the ocean or a European country calls for a ban, TMC stock takes a hit. This binary risk is why Fidelity mutual funds and conservative Fidelity ETFs largely avoid the stock. It's too binary for a pension fund. But for the self-investing crowd, this binary outcome is the appeal. If they win the U.S. permit, the stock could multiples. If they are blocked permanently, it goes to zero. There is very little middle ground. This brings us to the technicals. The stock has support at $5 and huge resistance at $6.50. It's trapped in this channel. Today's price of $5.41 puts it right in the middle of the range. We're seeing the 50-day moving average start to curl upward, a bullish signal, but the RSI is cooling off after the overbought conditions earlier in the month. Traders using Robinhood app charts will notice a bull flag forming on the weekly time frame. This typically implies that the recent explosion in price was the flagpole and the current drift sideways is the flag, often preceding another leg up. But technical analysis on a news-driven stock is always secondary to the news itself. One headline from the White House or a court ruling in the Ninth Circuit could invalidate every chart pattern instantly. Let's pause for a moment. I want to hear from you. Comment below with your take. Do you think the environmental impact of deep-sea mining is a necessary evil for green energy, or should we leave the ocean floor alone regardless of the nickel shortage? And if you are holding, comment how many shares of TMC, the metals company Inc., you currently hold. Now, let's look at the competitive landscape. Who else is doing this? In the public markets, almost no one. There are private ventures and state-sponsored entities in China and Russia, but for a U.S.-listed equity accessible through Robinhood crypto accounts or their equity side or Fidelity brokerage, TMC is the only pure play. This scarcity value commands a premium. If you want exposure to deep-sea mining, you have no other option. This forces capital into TMC simply because there is nowhere else for it to go. It's a monopoly on a speculative thesis. Even if you